Hi everyone, welcome to my Stockholders Equity Lecture Series. This video is going to be focused on corporations and equity ownership. Prior to getting into the detailed accounting for stockholders' equity, I just want to go back and recap for just a few minutes. Some of the things we covered early on in the course when we talked about setting up business, right? And we talked about getting up and running and the different types of businesses. And just spending a few minutes recapping that and maybe expanding on it just a little bit will help us kind of lead the way into exactly what is stockholders' equity, why is it on our balance sheet, what purpose does it serve, and it all has to do with basically ownership structures of companies. So let's take a look. All right, first up, establishing a corporation. We talked about corporations are just one type of business that companies can have, but corporations are special in the sense that they're usually quite large. But even when they're not large, they have many owners. They trade stock between those owners, and public corporations trade that stock publicly on open markets. But opening a corporation or starting a corporation does require a little bit of legalities, I guess we'll say, to get things going. So first off, you have to obtain a charter from the Secretary of State wherever you wish to incorporate your business. And so you can incorporate in just about any state in the United States you want. However, companies are strategic about where they incorporate, and where they incorporate does not necessarily have to align with where their headquarters are. And to give you an example of this, I always ask my class, I say, do you know where most companies in the United States are incorporated? And sometimes people have heard of it, sometimes they haven't. But the answer to that question is Delaware. Now, Delaware is not a state that we think of often, not one we talk about often in terms of accounting and things of that nature. And Delaware, relative to the other states in the United States, is actually quite small and does not have a large population. And yet most United States companies are incorporated there. And the reason for that is because Delaware, a combination of reasons, but let me give you kind of the top two. Delaware has some favorable tax structures for corporations, so there's some money saved by incorporating there. And probably more importantly than even that, Delaware has a dedicated court system just for corporate law. And so that court system has been around a long time. There's a lot of history there, a lot of knowledge there. And basically, instead of corporate court cases getting stuck on long dockets behind other cases that don't even involve corporations and not getting resolved for many years, court cases in Delaware for corporations have their own court where they're basically fast-laned into getting a hearing. And those hearings, I believe, are not held with juries. They're judge only, so you don't have to worry about getting jurors together and the problems that come with juries, such as human biases and things of that nature. And so most companies like that favorable treatment. They like the established history of corporate law. They like the fast lane of dealing with legal matters. And so most states incorporate in Delaware. And other states are trying to mimic what Delaware is doing. Nevada is a good example that's trying to kind of mimic Delaware's corporation favorable systems. But Delaware kind of has the head start. They were the first mover on this. They've been at it for a long time. That's where most companies are. You have to obtain a license from all the other states where you want to do business. So you incorporate in one state. You do have to have a physical presence there. And so there are these large buildings in Delaware that just have P.O. boxes, post office boxes, and those are like the official mailing address of the incorporated company, while their actual headquarters are located somewhere else altogether. And of course, if you're going to do business where your headquarters are, even if they're not in your incorporation state, you need to obtain a license from that state to do business. And if you're going to do business in another state, you have to get a license from it, and another, and so forth and so on. So you need licenses to actually do business. You have to establish some corporate bylaws, and I say here, including an ownership, management, and governance structure. So you have to establish what executive positions are we going to have in our corporation? Who's going to be the oversight body of our corporation? Or how many board members are we going to have? What are we going to require those board members to hold in terms of qualifications? And ownership, kind of the key one to focus on here. How are we going to structure our company in terms of ownership? Are we going to sell stock? How much stock? What types of stock? So forth and so on. And of course, once all of that is established, we get to kind of this final piece. And here's kind of where we went. We skipped some of these legalities when we spoke about this way early in the course. Then you have to raise money. Right? And this is how pretty much any business happens. You can't do a business. You can't operate a business without the capital or the materials or the buildings, basically our assets, in order to do that operating. And so if you need to get to operations, you need assets. Well, to get to assets, you need funds. You need capital. And so once you have all the legalities out of the way for a corporation, you need to raise money in order to then fund your business. And that's where stock is going to come in. So stock is how we raise capital from owners. We've already talked about debt in this class, issuing bonds and that sort of thing. That's how you raise money from creditors, from debt holders. But if you want to raise money from owners, instead of being on the hook to pay somebody interest over a set amount of time and then pay them their money back, instead you want to say, hey, you can give me money in exchange for owning a chunk of my business. That's where stock comes in. I have over here some terminology, and I just want to get that out the way right up front because we're going to see these terms later on. The money corporations raise from their owners is referred to as paid in capital. Okay, that's the overarching term. So when we talk about stock, the money you receive from that stock is part of this larger term called paid in capital. The capital people pay into your business. The term makes sense, right? Paid in capital is generally received by issuing common stock or preferred stock. We'll talk about the differences between those two shortly. Know that as we see some examples throughout the class, you're going to see some other kind of strange types of stocks on companies' balance sheets. And, there are various types of stocks that companies can put together to sell to their shareholders. But we generally bucket them, for the case of an introductory accounting course like this, we generally bucket as there's the common stock, there's the preferred stock, and there's going to be some subtle differences between the two. And then any funds that are raised in excess of the face value of the stock, something we call the par value, is what we call additional paid in capital. So what ends up happening is you've got stock. That stock might have a face value on it. It may say $1, might say $2, $3, often not even that high, usually a penny or a fraction of a penny. And we'll talk more about that later. But they'll have a face value on it. And from an accounting standpoint, you've got this overarching thing called paid in capital. And within it, you've got the face value of the capital, which is whatever's written on that stock. And then you've got anything in excess of that face value that investors actually pay to get your stock from you. That's what we call the additional paid in capital. Okay? And over on the left here, I just want to draw your attention to this diagram just to give you an idea of how things operate. We probably already have a good sense of this from all the other lecture series you've already been through in this course, but just to kind of, again, give us that reminder before we get deep into shareholders' equity. You've got your investors. Your investors are going to give you some capital. All right, that capital could be the face value capital or the additional paid in capital. So that's why I have additional here in parentheses. That capital is then used to fund your operations. Your operations are going to generate what's known as your earnings or your profit. From there, you have two choices. You can either give some of that profit back to investors in the form of what's called a dividend, or you can put those earnings back into your business to fund future operations, and that's what we call a retained earning, or retained earnings is how we generally refer to it. And so this is kind of just the cycle of how things operate. Investors come in, they give you money, you operate, you get earnings, give some back to investors if you want, put some back into your business if you don't give it back to investors, and the cycle just goes on and on and on. All right, let's talk about some of the differences. I said we were going to come to this on these different types of stock. So again, in this class, we're going to focus on kind of the two broad categories of stock, the common stock and the preferred stock. Common stock is typically what we're talking about. When you hear somebody talking about stock, when you hear somebody talking about, oh yeah, I bought some stock on the stock market today or whatever, you're generally talking about what's known as the common stock. Essentially, it's a share of stock that gives you ownership in a company. Usually it gives you a proportional share of voting rights. As an owner, you have a say in the direction of the company. Now, keep in mind, you have to own a lot to have any real influence, right? Because if a company has 1 million shares of stock and you own 10, well, sure, you have 10 voting shares, but 10 out of 1 million isn't a lot of influence. So it takes a big chunk of stock in order to get enough voting power to really sway votes. But as a shareholder, you do get a say in the direction of the company, no matter how small that say may be. You get a proportional share of any dividends that are declared. So again, I mentioned on the last slide, dividends, when companies give some earnings back to the investors. Whatever your percent ownership of the company, that's the percent claim you have on whatever that total dividend that goes out is. So proportional share of dividends. And common stockholders have a residual claim to liquidated assets. So should the company go out of business and need to liquidate, if there is anything left in the company by the time every other debt is paid, then that is proportionately broken up and given out to the shareholders. And I'll tell you right now, let's just put an asterisk on that one, because frankly, if a company is in so bad shape that it really goes under, chances are nothing's going to be left by the time you get down to the shareholders. You have to pay whoever holds kind of your senior notes with, your bonds that have priority. You have to pay out the other bondholders. You have to pay off your just everyday debts. You have to pay your preferred stockholders potentially. We'll talk about that in a minute. And then if there's anything left, you pay out to common shareholders. And frankly, if a company's in that bad of shape, there's not going to be anything left. But it is a right they have. If it were to be possible, it is a right they have. Preferred stockholders, what's the difference? Well, preferred stockholders often don't have voting rights. It's not to say they can, but often they don't. It's kind of one of the things you give up to be a preferred stockholder. So then the question is, well, if you're giving something up, what are you getting in return? Well, preferred stockholders have a guaranteed dividend amount. And I say guaranteed, I guess maybe the more appropriate word would be fixed dividend amount. Basically, preferred stock, the main difference between it and common stock is preferred stock behaves like debt. Okay, so think of how debt operates. You borrow money, you have to pay fixed interest payments, and then you have to pay the money back at the end. Preferred stock is equity, but it's got debt characteristics. People are giving you money. You have to pay a certain designated dividend back to them, similar to an interest payment. The only difference is on the back end, you don't have to pay back the principal, right? Because this person bought ownership in your company. This person didn't loan you money. So there's no principal payback. But the dividends are essentially like interest payments, and it's a fixed amount. There's a priority right to receive dividends if you're a preferred shareholder. So if you've got preferred stock and the company declares a dividend, you get paid before the common shareholders more often than not. And there's a priority to residual claims. So again, if a company liquidates and there's some assets left after all of your kind of senior bondholders and all of that is paid off, gets to the shareholders, whatever's left over, the priority shareholders, they're going to get paid first. And then the common shareholders, if, once again, there's anything left, get paid after that. So you kind of give up voting rights, but you do it for some debt characteristics and you do it for some higher priority in various claims. And then, even though this isn't a separate type of stock, let me just talk a little bit about early or large stockholders. So stock, as companies issue more and more over time, if you think about percentage of ownership, you think of, if you bought, again, going back to, if you bought 10 out of 1 million shares of stock, you own a very small fraction of stock. But let's say the company issues another million shares. Now you own 10 out of 2 million shares of stock. What was already small has become even smaller. That's what we call dilution. Okay, your ownership gets diluted as more shares are introduced to the market. Often companies, when you have early shareholders or really large influential shareholders, they will get an anti-dilutive clause, essentially. And what that does is it gives them a preemptive right to purchase from that additional issuance of stock to maintain their existing percent ownership, okay? So it could be common stock, it could be preferred stock. Basically, it's just a right that companies will sometimes give to their early or their large stockholders as kind of a bargaining chip, basically. It's like, okay, you're going to invest in me early. I'm going to make sure that you don't get diluted should the situation arise. Or you know, oh, you're going to be a huge stakeholder. You're going to give us a lot of money. I'm going to give you the opportunity to be anti-dilutive, to keep your percent ownership if we issue more later. That's the idea there. And then the last thing I want to show you on this slide, you see this nice little graphic from Disney. We are ever more going to a technology-oriented world, right? To a digital world. And the stock market is no different. Most stock trading is just done online these days, right? It's not really done by shouting things on the floor of the stock exchange like it was at one point in history. And stock certificates are no different. So stock certificates at one point in time were paper certificates that you held, and they had the corporation, and they had how the face value, or what we call the par value, and things of that nature on them. We're entering a world where paper stock certificates are starting to phase out, and Disney's one example of that. What you see here is a paper certificate that you can obtain from Disney. You can only obtain it if you are a stockholder of Disney stock. If they sell it to you as a commemorative paper of stock to display that you do own Disney stock, if you'd like to put that on display. This is not an actual stock certificate, because Disney is one of the companies that is basically taking their stock digital. They don't do paper anymore. And we're going to see more and more of that as the years go on. So I just want to point that out. All right, that's it. Again, this was just kind of the let's recap how corporations come to be. Let's talk about the need for stock. Let's lay the groundwork with some terminology, tell you the differences in some of the stock we're going to talk about, just kind of the primer before we start the actual accounting. And so with the next video, we will start that actual accounting, and we'll build into all of the various components of the shareholders' equity section of the balance sheet. That's it for now. Hope you enjoyed this video. Hope you join me for the next. Have a great day.